Good morning. It's Monday, November 6th, 2023. It's 8:30 a.m. on the East Coast. Doing this video on a different day, at a different time, in a different location, keeping it interesting. We're going to be a little bit more abbreviated here this morning than I would normally be on a Saturday or Sunday, but there is a lot to get to. Simply stated, last week, one of the biggest rallies I've seen in a long time. In fact, it was the biggest rally week for equity since November 2020. You can see that this is where equities went out 2 Fridays ago. So October 27th, remember, we're getting ready for the invasion of Gaza by Israel. A lot of tough talk, threats being made by different countries and terrorist organizations. And there was a lot of fear going into that weekend. Well, the fear transitioned into optimism by the end of the week. So one of the biggest 1 week rallies in a long time in history, actually. The S&P went up about 270 points. A lot of sectors were up 10 or 15% last week. A lot of individual stocks were up 20% or more. It was a pretty incredible rally week for equities. We got this Zweig thrust, a rare technical signal. It's only happened maybe a dozen or so times in the last 50, 60 years. And basically, to boil it down, it's a signal that occurs when a lot of stocks are falling, and within 5 or 10 days, that transitions to a lot of stocks rising. So basically, the market is falling with very weak breath, a lot of stocks making new lows, and then in a short period of time, everything shifts, and you get suddenly a lot of stocks rising. And a lot of people were talking about this over the weekend, that this Zweig, the ZBT signal, right? And I found this article from 2015, which reviews this, going even back to the 1920s and 1930s. And basically, in a bear market, which was what the 1930s were, this signal isn't very valuable. Okay, there's a lot of bad signals that occurred in the 1930s, a lot of ZBT thrusts. But then as the market became more bullish in the 1950s and 1960s, the signal became more bullish. I mean, and this is just basically technical analysis, period. Like if you can gauge if the market is in an uptrend, in a bull market, you will know how to trade it and which signals are more valuable. If the market is in an oscillation, you'll also know which signals are more valuable and which ones to ignore. And if the market is in a bear market, same thing. You'll know which signals to ignore and which ones are more valuable. So nothing too valuable here. A lot of people making a big deal about this. But tell me, are we in a broader bull market in the S&P 500, or is this a bear market rally? And then I'll tell you what you should do. Really as simple as that, okay? It is a very powerful turnaround in a very short period of time. You can see this is a perfect V bottom in the SPY. So as a technician, I need to respect this signal. I need to respect the price action of last week and how powerful buyers overwhelmed sellers on Wednesday, Thursday, and even into Friday. But I also have to respect this downtrend that we've been in since the summer, and that this rally may have only served to really squeeze out a bunch of shorts and rallied us right back to resistance near 4,400 on the S&P. I look at the NYMO, which is a good oscillator. When it gets above 75, it's overbought. When it gets above 100, it's extreme overbought. So we got down to about minus 50, minus 60 reading on that week going into the invasion of Gaza. We were oversold, but as I said in the video last weekend, we're not extreme oversold. So there was room for further downside. Well, we just went straight up. So we went from mildly oversold to bordering on extreme overbought now. And you can see put buyers capitulated at the end of last week. So the put call ratio ended the week at 0.54. It had been as high as 0.9, right? So 0.9 or 1 on the put call these days is a very, I guess, extreme over bearish sign, right? It rarely gets above 1 these days, especially with this ODT8E options game that everybody's playing. But here we are. We're back into complacency. We're back into people way overboard on calls and light on puts. So heading into this week, I think there's definitely some room for a little pullback, a little consolidation. You can see I have this green line drawn on my E-mini S&P chart. I think 43.35 is a very reasonable pullback downside target. If at some point in this week we got under 43.35, that would be the first signal that, okay, this might be more than just a little consolidation pullback in the context of a new uptrend, right? And the purple line near 4,400 on the E-mini, that's sort of my next overhead level to be watching out for. And then you could go back to October 17th high at just above 44.20. You can see there's a lot of levels just above where we're at. Okay, so we're starting to get into the tall grass here. Last week was an explosive rally, and now it becomes a lot harder. Okay, I think that's the main takeaway that I want to let you have here. But with Powell basically insinuating that the Fed is probably done, and then we get a very weak jobs report on Friday with downward, revisions to prior months that totaled over 100,000 jobs. Suddenly, we've gone from a situation where the market a month ago was pricing in one more rate cut, possibly two, to no more rate cuts, and now there's actually a chance of there's no more rate hikes, and now there's a chance of a rate cut as early as March of next year. So suddenly things got a lot more dovish, and the whole higher for longer thesis is somewhat in question after last week's action. Really, at the end of the day, it was this moderation in yields that sent everything risk on last week. You can see QQQ. So this is the daily chart, rallied right into resistance. So this downtrend line off the high. So this is now a really important level in the QQQ. I would say, resistance 369, 370 is definitely not going to be easy to just blow through. The easy gains have been made already last week. Okay, there's this thrust off of the 342 low, up above 350, up above 360, and now it's pretty overbought. IWM, Russell 2000. So the small caps have been the laggard of the entire market, and they got up to the falling 50 days. So if you look at all of these different charts across the stock market landscape, they're all either at very key technical levels or very close to resistance levels, and we're overbought, right? So this is a textbook setup for a pullback early in this week. Fundamentally, the earnings have been fantastic, right? More than 80% of S&P 500 companies have beat the earnings targets of analysts, right? So they've beaten the expectations of the market. Some bigger companies, Amazon, Microsoft, have crushed the estimates. And you can see this chart that earnings just across the S&P, across various sectors, are beating on revenues, and margins are increasing. So companies have braced for a recession, over the last year or so, yet it hasn't really happened, and sales are still strong and growing. So last week's rally was multifaceted. It wasn't just about, okay, the Fed is done. It wasn't just about, okay, World War III is not happening tomorrow. Um, it also actually had to do with the quality of earnings that companies have been posting across the market. I do think it's important to emphasize that the sharpest rallies do not occur in bull markets. Bull markets are kind of steady, two steps forward, one step back, keep gradually making higher lows, higher highs, but you're not talking about 2%, 3%, 4% gains in a single day very often during a bull market. Um, the most aggressive rallies occur in downtrends and in bear markets, right? And so I think that's something. It's very easy to flip bullish here. Uh, we've been going up. The magnitude and the aggressiveness of the rally, was impressive. Don't fight the tape. Let's all get long. But I think that would be a mistake here. Okay, I think that as a technician, I have to be a lot more cautious here, and respect that we're at a level, after last week's extremely aggressive rally, where we could definitely see some downside early in this week. But it's also not the sort of setup where you would want to be aggressively shorting because of the aggressiveness of this move. And it's possible that we could still have higher to go here in the near term. But if the rally stops right here, it would be just an absolutely classic bear market rally sort of move, just stopping out every short on Thursday and Friday of last week, getting everybody buying call options again, and then just pull the rug out again. And this is a vicious market. Okay, this has been a very tricky market to trade and quite treacherous. So, sort of going back on that Fed theme. So, remember that back in 2020, every central bank was cutting rates and easing policy. 2021, a lot of people paused, and then 2022 was characterized by tightening and no rate cuts by global central banks. Well, now we're back into what appears to be the beginning of an easing cycle, with many more central banks around the world starting to cut their policy rates again. Okay. So this is also a bit of a tailwind for gold, right? So, if you just think back to 2019 and 2020, how would you characterize those years for the gold market, right? They were bullish. Yes, there was a lot of volatility, no doubt, but gold was 1300 in 2019. And at some point in August of 2020, it traded above 2000. So those were bullish years for gold. How would you characterize 2021 and 2022 for gold? Well, I would generally say they were bearish, right? Because gold fell from near 2000 to a low of 1625, right? In Q3, Q4 of 2022, right? But now gold is having another swing higher. We're at 1990 here this morning. And it just so happens it coincides with more and more central banks cutting their policy rates, right? So there is definitely a correlation here between gold and central bank monetary policy globally. So if this is correct, that we've gone from a tightening 2 years, 2021 and 2022, to more of an easing trend, then I would probably assert that gold has higher yet to go. Okay. So we can get rid of these equity charts, Zweig, breadth thrust, put call, S&P, Yeah, ARKK also had a tremendous move, up 5.64% on a Friday, and back to gold. So, uh, continuing with gold, China continues to accumulate gold at a very fast pace. And I believe that this is because one of their objectives is reserve diversification, right? So away from US treasuries, let's say China has $1 trillion in treasuries, they're going to gradually diversify some of that, maybe 30 billion a month, 40 billion a month, but they're going to gradually move away from US treasuries, de-dollarize their reserves, and gold has a role in that de-dollarization, right? So in the last year, basically, China has bought nearly 8 million ounces of gold. That's about $15 billion US. Imagine what would happen if they doubled the pace of that gold accumulation. Already, we've seen gold move from 1625 to over 2000 during this time of China's, accumulation. Imagine if they doubled the pace of it, right? And I'm not saying that China is the only factor in the gold market that's driving it up, but it is a big factor. Um, I zoomed in on this weekly chart to show this hanging man candlestick, potentially bearish candlestick, keyword potentially. I think at the very least, gold is due a pause here, a little consolidation, maybe between 1970 and the low 2000s. I think that would be very healthy. But bigger picture, I think gold is preparing for that breakout move. Okay, but I have to think it doesn't come so quickly. I think that we have some more backing and filling, some volatility, some shaking people out before gold eventually does make that move. Maybe the move will come the final week of the year. Maybe it will come in January. Maybe it'll come in February. I don't know. But I do know that this has been a very sharp rally in gold from 1820 to over 2000, and some consolidation here near this 2000 level is appropriate. It's interesting how silver is lagging gold. Obviously, silver has a big industrial side to it that gold doesn't really have. But you could sort of see a little bit of a head and shoulders bottom forming in silver with the neckline, the breakout line at $24. And if we look at the GDX chart, it's very similar to the silver chart. The GDX chart is actually closer to the silver chart than it is to the gold chart, which is interesting. It's sort of like silver is a better sentiment tell for the miners than gold is, and gold is more of that flight to safety bid that silver and mining stocks don't get, right? So gold itself really benefits from the central bank bid and the flight to safety bid, but miners are treated as stocks and risk on or off sort of vehicles. So Friday was a risk on day across markets, and the GDX was up 4.28%. So this is a very clear head and shoulders bottom. The neckline is at $30. So breakout above 30 would definitely target up to near 33 or even maybe a little bit higher. So this is a pattern that we should be cognizant of here this week and over the coming weeks into year end. And just seasonality, a lot of people are focused on tax loss selling. Well, I would say tax loss selling is more just about junior companies. So let's say under 50, $60 million market cap companies will probably be affected to some extent by tax loss selling in these final 2 months of 2023. But the bigger companies, over 100 million, certainly over a billion market caps, I don't think it really affects them. And seasonality, November through February, is pretty bullish for the gold miners. So we are now into a period of favorable tailwinds for the gold mining sector. Yeah, and so this head and shoulders bottom pattern is very, very much in play, and it's just very interesting to see a positive technical pattern taking shape at a favorable time of the year for the sector. and everybody still hates the sector. That gold miners are the most hated sector. And in my mind, I think this is a perfect setup. Okay. So I'm going to keep moving on here because I don't want to make this video too long. XBI biotech. This is one of my themes heading into next year. I blogged about it a week ago. I basically called a bottom on it at 66, I think, saying that this is really a major buy opportunity in 2024. Could be a very good year for biotech. I'm not going to go into that just for the sake of time, but definitely take a look at the XBI and medicalgold.ca and check out that article. Mind medicine. So I talked about mind medicine, what was it, 2 weeks ago? Said I've been just wrong on this. Yeah, I have been wrong on it, but it was also up Thursday and Friday of last week, up big. Again, bear market rally or whatever. MindMed reported earnings last Thursday, and I mean they don't have earnings per se, but financial results. And basically, they reiterated their phase 2B anxiety study is on track for a readout, top line readout this quarter. And they pushed back the ADHD phase 2A a little bit till end of Q1. But I think the big thing is for the market is cash and cash equivalents of 117 million. So MindMed is displaying some financial discipline in terms of spending, and they have a bigger cash hoard than their market cap is currently, right? So the market took that and ran with it on Thursday and Friday. So that's something for you to do a little more research on if you care. But MindMed, even after Thursday and Friday, has a market cap under 100 million US and cash and cash equivalents of 117 million. I'll just say a little something about that. In the biotech sector, especially early stage, so like phase 1, phase 2, you have to expect these companies are going to spend cash at a pretty good clip. A company like MindMed might spend 25, 30, 35 million a year, all depending upon how many trials they have going on at one time. But you have to expect them to spend money at a pretty good clip. So I wouldn't necessarily look at this like a Berkshire Hathaway, like the stock should trade above its cash. But the cash is certainly a very nice cushion. And if their annual total spending rate is 30 million, well, 117 million gives them 4 years of runway. I'm not saying that's what it is with MindMed. I'm just throwing out those numbers as an example. Obviously, they could increase their spend if they move the MM120 to a phase 3 trial. It's going to vary year to year, and you have to keep up to date with it. But this is a big enough of a cash hoard that the company is not in any danger at all near term, right? I mean, this at minimum is cash runway through to 2025, right? So I think the market was sort of reinvigorated by this report, and a company that hasn't done a very good job of communicating with the market seems like they have turned that around here last week. So MindMed definitely still on my radar. Palantir. So two of the key themes of this time in market history is definitely AI and counterterrorism, right? So what is going on in Israel, the Middle East, even Europe, we've seen some terrorism, right? So AI and counterterrorism, big topics du jour, and Palantir is like at the intersection of both of those domains, right? So not going to go into this in great deal, but I'm just going to throw it out there as one of my ideas for this point in time and into 2024. Obviously, the technicals look very good. It bottomed. It put in basically like a 12-month bottom rounding bottom in 2022 and early 2023. It's obviously moved up. It had a big rally week last week. So I'm not, by bringing this up, I'm not advising anybody chase it and buy it right now. I'm just inviting you to put it on your radar and maybe learn a little bit more about the company. And that's the same with any of the stocks I talk about, just inviting you to put it on your radar and maybe learn more about it the same way I'm learning more about it, not an invitation to buy or sell anything. Smith and Wesson. So it's interesting, again, with the counterterrorism, terrorism, violence angle. There's a lot of violence in the world today. Speaking to some of my friends, some people who were previously really anti-gun are now buying handguns, which is a very striking trend, that people who were previously really anti-gun and wanted nothing to do with firearms are now feeling so desperate and concerned for their safety and their family's safety that they have gone out and bought handguns. Smith and Wesson. You could say, well, it's overbought. It's already run up so much, Okay, maybe, but this may be a secular trend. And anytime that there's like a fight over the Second Amendment in the US, somehow usually there's a good trading opportunity in the gun makers like Smith and Wesson or Ruger. And another thing I'll just throw in here, it seems like the New York Times polls and just what I'm hearing and seeing out there, the country is moving back to the right. And certainly a Trump win would be considered to be positive for a company like Smith and Wesson. So just another stock to throw out on your radar for 2024. So we finish up with Hercules Silver. Why have I talked about big.v on the venture exchange the last 3 or 4 weeks? Well, because it's very topical. It's very interesting from a technical trading standpoint, and also a market psychology standpoint. So what happened last week? Well, everybody is waiting for the results of the next deep drill hole at Hercules. Hole 2308 would be the next one in the chronological order. And instead, the company put out news on November 1st talking about 2 of the shallower drill holes focused on the silver, lead, zinc, the near surface silver, lead, zinc. Again, remember, the company had a couple different objectives from this year's drill program, and one of them was to drill enough of the shallow stuff to be able to put a resource on the silver, lead, zinc zone, right? So the market, being impatient, was disappointed that on Wednesday that there was no results from the deeper drilling, right? And so Wednesday, Thursday, we had a little pullback, consolidation, but then Friday, buyers stepped back in and drove it up to 93 cents, close at the high of the day. Now, from a technical standpoint, this is actually really textbook perfect action, because at the low of the day on Thursday, the relative strength index, the daily RSI 14 up here, had pulled back to about 65, 66. So we went from extremely overbought above 80 and pulled back to 66, which is more of a normal reading for this momentum, this momentum indicator, right? So cooling off in the context of a big uptrend is extremely healthy. You do not want to see a stock just go straight up every single day. So a little consolidation, a little pause is extremely healthy. It's also important to just take a look at this, news. The company starts out saying it's continuing to wait on assays for the next deep drill hole, HER 2308. And then even if you go further down into this, the company talks about the IP data is beginning to outline and anomalous chargeability extending from the 2022 survey. And he even talks about the timing of the 3D inversion models around Christmas of this year, and even says we're excited by the early, results from the IP. Yeah. So it's in this paragraph it talks about the size of it, 4 kilometer by 4 kilometer super IP, 3,000, more than 3,000 acre target area. Early signs show encouragement for expanding the 2022 anomaly. So, the the writing in this news, release is a little more conservative, trying to sort of, I guess, moderate the market expectations. But in reality, I think the company is very excited. It's not just mildly excited, right? But better to under promise and over deliver, right? So there's nothing wrong with this news release at all. This is and even the results of the shallow holes, 25 meters of nearly 200 grams silver with a lot of little lead zinc silver, even some tin, or sorry, some antimony. Got my chemical symbol off there. 41 meters of 138 grams silver. I mean, these results are great considering how shallow these drill, holes are, and how continuous the silver lead zinc is, right? So this is a company that is doing everything right in my mind, and the little selling out of impatience on Wednesday and Thursday of last week is just the market being the market. Okay. So nothing has changed in the Hercules Silver story. Even their deck is the same, right? And still super intrigued by the depth of that hole 26, and also hole 21 looks like it was a very deep hole as well. And you can see they're actually kind of terminating somewhat close to each other. But anyway, we are waiting the first deep drill results from Hercules Silver. I don't know when they'll be out, but definitely I would expect, within the next couple of weeks. I know that an impatient market wants it to be this week, but we just don't know. So that's it. Oh, I forgot about this. Yeah. So in the deck, where is the slide? I always forget where this slide is. No. Here. So they clearly state that many directions, remain to be tested, and the potassic center, which often carries the highest grade, within porphyry systems, remains to be found. So just for people that are learning about porphyry systems, this is a good model of what they can often, look like. Conceptual porphyry copper gold model. And the potassic, you can see, is the dark red, and the cerasitic is the green above the dark red. Well, the hole 2305 tapped into some of the cerasitic at Hercules, but it did not go deep enough. It did not find the potassic, where the higher copper gold grades are expected to be. So that's why the deeper drilling, like even in hole 2308, is deeper, right? 2305 had to be terminated prematurely. And then obviously holes 21 and 26, much deeper drilling, are so intriguing because of the fact that as of this moment, according to public knowledge, Hercules has not tapped into the potassic part of the system yet. So we will leave it there. And until next week, thanks for tuning in. Please follow me on Twitter at CEO Technician, CEO.ca, at Goldfinger. And if you found value in this video, if you enjoyed it, please hit the like button and subscribe. Have a powerful trading week.